Alright everybody, let's finish up this Marlin Guitars example by preparing the statement of retained earnings and the statement of comprehensive income. Firstly, in our statement of retained earnings, what we're going to have here is whatever we began the period with. Well, we got to have that information somewhere, so let's go into our info and see if it tells us anywhere what our beginning retained earnings were. There it is. Marlin Guitars had a retained earnings balance of $12,400,000 at the end of the prior year. Well, if we ended the prior year with $12,400,000, we have to be beginning this year with that same amount. So let's fill that in, $12,400,000 in beginning retained earnings. Then we have to see if we have to make an adjustment to our retained earnings. Things happen. Mistakes are made. And there's times when a company will report the wrong amount of retained earnings at the end of the prior year. Well, you can't, and you'll find it afterwards, but you can't just start with a different number for your beginning retained earnings than you ended the prior period with. If there's a discrepancy, you have to say why in your statement. So let's go through our info and see if we have a discrepancy, something went wrong with our retained earnings last year. And as we are scrolling through our info here, we see right here that an amortization error during the prior period caused net income to be understated by $210,000 net of tax. So somewhere along the lines, one of our accountants recorded an amortization expense that was too high, or they, inadvertently recorded the same entry twice. But something happened where we had $210,000 of amortization expense in our income statement last year that shouldn't have existed. So what do? Well, since our income was understated, that means our retained earnings also has to be understated. So if we just take those two numbers and we add them together, we're going to tell users of our information that we should have reported retained earnings of $12,610,000 last year, not the $12,400,000 that we reported because we messed up on an amortization expense somewhere. So that's what we should have started with. Now we can add to it what we made during the period, which is our net income allocated to Marlin shareholders, which we're going to find on our income statement. Net income allocated to Marlin shareholders was $1,220,000. And if we add those two numbers together, we're going to get a no-name subtotal of $13,830,000. And I'll take a moment here. This little green arrow popped up over here, and you might see that. If it happens, you can just scroll over to this drop-down box right here and hit ignore error, and it gets rid of it. Those things pop up when your cells and adjacent cells don't have the same formula, which happens a lot in accounting. So if one pops up, don't think you did something wrong, you can just turn it off. Okay, so we had $13,830,000 for the retained earnings that we could have kept, but we didn't keep all of it because we distributed at least some of that to our owners, and we distribute it in the form of cash dividends. So let's go into our information and see if we can find our cash dividends. Well, it says right here that we paid 60 cents per share dividend during the last year, or during the current year. Well, it's 60 cents per share. How many shares did we have? And we had that information from before that we were using, that Marlin currently has 500,000 shares of stock outstanding. So how much did we pay out in dividends? Well, we paid out 60 cents a piece to 500,000 shareholders. So if we multiply those two numbers together, it's $300,000 in dividends. We could have kept $13,830 worth, $13,830,000 worth of retained earnings, but we paid $300,000 of it out to our owners, which means we are retaining $13,530,000 worth of retained earnings. So those cash dividends have to come out of retained earnings, which means our owners are going to look at that number and be like, that's how much they could pay us. If we have a portion of this retained earnings which is restricted for something else, that's not available to be paid out in dividends, so we need to disclose that information to users of our information. So let's go back to our info and see if we have a restriction for anything. And if we're going through in here, we're going to look around and see if we can find a restriction, and there's one right there. Marlin Guitars is restricting $250,000 of retained earnings for the purchase of new office equipment and furniture. Well, we have to let users of our information know that $250,000 is not going to be there for them, because we're going to eventually use it to buy new assets. So how are we going to do that? We're going to do a footnote disclosure, which means you just put something within the statement. I put an A in here that signifies, hey, there's more information about this, read about it in the notes. Then underneath in the notes, we are going to say $250,000 of retained earnings are restricted for the purchase of new office furniture and equipment. And it's as simple as that. If there's more information that you want to give to people that you don't want to put into your financial statement, but you think people are going to want to know, use a footnote citation and disclose it in the notes to your financial statement. With that, we're done with the statement of retained earnings. We can move on to the statement of comprehensive income, which is the last of the financial statements you're going to have to prepare in this unit. So again, net income. We're going to start with our net income, which is attributable to our Marlin shareholders, which is that $1,220,000. Let's bring it on over. It's a pretty good number, but we could have had more. Why could we add more? Well, if we look into our information, we see that Marlin has an unrealized holding gain of $30,000 in an equity investment, which is appreciated. So if we sold that investment right now, we could have got a gain excuse me, on the sale of this investment, and therefore increased our net income. We didn't. It's not fair to Marlin to be able to say, you know, our income's not as high as we want because we didn't sell this and inflate our income as high as we possibly could, and that's comprehensive income. So we want to tell our investors, yes, that was our amount of net income we had during the period, but it could have been higher. We could have had $30,000 extra net income if we sold this investment. And if we go back over and we look in here, we also see that we have an unrealized gain of $50,000 on a note receivable due soon from a foreign company. And this is an accounting lingo called a gain from a translation adjustment. So when you're doing multinational transactions, you have to denote those transactions in one currency. So let's say an American company is doing business with a British company, and the transaction's denoted in British pounds, sterling. They say we're going to send you, X amount of pounds on this date in the future. Well, when we recorded it, we had to record it in US dollars because no one wants to look at financial statements that have 8 million different currencies in it. Well, what happened if the price of the pound went up versus the US dollar? The money that we're going to get from this company is going to be more than the receivable is worth on our books. So if we had them pay us early, we could have experienced this gain from a translation adjustment. We know it's coming at some point. So what are we going to do? We're going to have an unrealized gain from a translation adjustment of $50,000. Which means that in total, yes, we had $1,220,000 worth of net income. But if we sold our equity investment, and we either sold this receivable or got them to pay us faster somehow, our comprehensive income, our net income, could have been $1,300,000. And with that, we're done.